Guys, we're back here with another Common Desk Happy Hour. Pleased to introduce y'all to our guest, Todd Savage. Todd, can you give us a little bit more about your background, your experience, and your team at JLL?
Yeah, I grew up in Houston and went to the University of Texas at Austin and got an MBA at SMU and been in Dallas ever since, and glad to be in Dallas in the current environment.
We met Todd most recently on a Common Desk building that transacted a few months back, where Common Desk was in on a management agreement, and Todd and his team really got an exclusive look into what it's like to sell co-working to prospective buyers, how they react to different structures, whether it's a lease or a management agreement. And Todd, kind of before we go into CityLine, what did your previous history look like selling co-working deals, looking at leases, and kind of what was the sentiment, let's call it, for the last 3 to 4 years around co-working?
Well, I'll go back more than 3 or 4 years. So we've worked on co-working deals ever since I've been in the business. So historically, it's been more of the executive suite operator, which tended to be the second or third floor space. Looked in the garage, you couldn't lease, and so you put an executive suite in there. It's obviously changed over time, where now it's much more of an amenity to the building. But it's always, what's the credit behind the operator? How's the performance look? A little bit of track record, all those things kind of factor into it.
Without naming specific brands, you mentioned those variables. What were some of the big things that would move the needle for value when you're looking at those deals? Was a lot of it sort of industry perception at large? Was it, how do people feel about co-working? I know the headlines have gone up and down over the last few years, versus how much of it was performance and track record and sort of brand perception around the specific operator?
Well, I think there's always been the mom and pops, the smaller, maybe they have 2 or 3 of them and they're more regional. Then you have the national groups. And I guess there's pros and cons of both. But it all came down to, if you toured the asset and toured the space, what did it look like? Was it occupied? Were there a lot of people in there?
For 3400 CityLine, kind of specific to that assignment, had you dealt with a co-working management agreement before?
I feel like we valued a lot of them, and our company had valued a lot over across the country. But that was one of the challenges. There just have not been many of those comps. As you mentioned before, track record is a big part of it.
And tell us about sort of guiding the sellers to, hey, this is about 11% of the rent roll for the building. Here's how we think it's going to be valued. Are you saying, hey, the management agreement's going to get the same treatment as a credit lease? Is it going to get discounted? Could the location was performing at a premium to market? Could you even get some of a higher cap on some of the premium income that's being derived from the space?
Yeah, and I mean, in the case of this deal, it was one of the first deals coming out of the pandemic, and so you had return to office concerns and bringing employees back to buildings, what that looked like. And so the fact that it was 11% of the building and not 20 or 30% of the building, I think, was huge. So it was definitely a portion of the income, but it wasn't a major piece. So that helped some of it. As far as talking to the client, we ran a number of sensitivity analysis and said, look, if we got just value for what the lease was, this is what it looks like. But if we got investors to underwrite all that upside, this is what it could look like, and there was real upside to it. So you really kind of gave them both options, but also said it's a bit of an unknown. We weren't really sure how the market would underwrite it, but we were going to, give them the statements and give them the facts and, give them the merits of the deal.
This building we're currently sitting in is actually not CityLine. It's 14555 Dallas Parkway. It's another building that's sold with a Common Desk management agreement. Did y'all look to this as sort of the best comp in the market on that 2019 sale?
We definitely looked at this, the fact that it traded well. This deal was more stabilized, so it was much more of a cash flow deal. 3400 CityLine was a newer building, still in lease up, so it had some vacancy. So in that case, that was more of, what is the cash flow today? What could it be in 3 or 4 years when the buyer was going to exit? So a little bit different, but the fact that this priced as well as it did, I think, was very helpful.
And walk us through how many of the buyers or prospective buyers that were bidding on the project were familiar with Common Desk and thought co-working was more of an attractor and not a detractor as far as their interest level goes?
Well, I think, in Dallas, pretty much anybody has a presence in DFW knows Common Desk and knows, the quality of their finishes and how well they do. And I think a lot of the groups that came from out of town and toured were really, pleased and impressed with the facility. So, mix of both, but I think it showed really well. And, I think the fact that it was in the lobby, it was one of the first things you see in the building, brought some energy to the building. I think it was a big help. And I think a lot of people like that.
To your knowledge, well, we won't just throw a bunch of softballs. Did having this co-working management deal preclude anyone from bidding, or do you think it was sort of a turn-off for certain buyers potentially on the deal?
I don't remember anybody saying, I'm not looking at that deal because of a management agreement or a co-working group in place.
Gotcha. And you mentioned that space is 31,000 feet. It's right off the lobby. Walk us through, was it helpful for actually selling buyers on the building? Do you think it was a good indicator for what back to office looks like and that it's a very active, kind of dynamic space?
So, I told Nick, every time we toured it, we went through the Common Desk space, and we toured it a lot. And in a lot of cases, we toured the building, the existing tenancy, the vacancy, and then we usually finish with Common Desk because, as I mentioned, we're coming out of the pandemic, and there are a lot of buildings we've worked on that didn't have many people in them. And in this case, we'd walk that space, and it was jam-packed, and people there, and energy, and it was a big part of the marketing effort, just seeing that energy that was within the building.
Had this been a management agreement with another brand, even if the performance was similar, do you think the brand brought specific value to the deal? Do you think the risk could have been higher if it was potentially another competitor?
I think, the fact that you guys have done this before and there's a little bit of a track record and other institutional owners have buildings with Common Desk in them, I think gives groups comfort. So I guess to some extent there's some of that. Track record, I think, is just probably the most important thing that we dealt with.
How was the co-working space valued at sale, and kind of what did that look like?
So I think most groups treated it similar to you treat parking revenue or even event revenue, or maybe even like in a case if you had retail and you had percentage rent. It's just a variable income item, and I think most groups looked at it as something that they're gonna perform it, but I don't think anybody bifurcated it and valued it separately than the overall income stream. We asked every buyer on the buyer interview calls, how did you treat it? And I don't know if we got a specific answer, but most people said, yes, we definitely give value to it. And I'm sure they probably adjusted our assumptions somewhat, but I think we got value for it.
And the location, if a market gross rental rate there, let's say, is around $34 a foot gross, and that location's throwing off about $41 a foot annualized probably at the time of sale.
Yeah.
Are people giving you credit for, or at least some credit, maybe at a higher cap, for that delta between $34 and $41? Did you see some of that in people's underwriting?
Yeah, I think so. And I think that having the management agreement was beneficial because that there's some visibility into the operations. So you had monthly statements that showed how occupancy was, what the income stream looked like, and just how it's performing. And having that, I think, was huge. So I think definitely there was some value given to that upside. It also worked out that this deal in particular had some vacancy, so it was a little bit more of a value add deal. So the fact that someone could underwrite what that future cash flow looked like, I think, was a big part of the upside and how they were looking at the deal.
Awesome.
As everyone's trying to figure out how to get employees back to the office, employers are looking for a reason for their employees to come back. I think co-working will be a big part of that. As far as that energy I mentioned, the programming you guys can bring to some of these buildings, I think that's all important, and I think any successful building's going to have some portion of co-working.
That's awesome. That's all I got, Todd.
Okay.
Appreciate it, man. This was fun.
Thanks for having me.